Hi, so today we continue our discussion on investment risk. So let's review the three fundamentals that we established in Risk Part 1. First is that in managing our investments and making our choices, it is imperative that we understand the risk of those choices as they vary significantly across asset classes. Secondly, we gave a reason why highly risked choices would be considered as candidates for investments, and that is the high correlation between higher risk investments and greater expected returns. Everyone wants more returns on investment, but not necessarily when the cost of taking on such a risk is enhanced likelihood of significant losses. So some balancing act is in order, which we will discuss in time. Thirdly, we alluded to the fact that younger investors are in a better position to take on more risk in order to garner those higher returns because they have more time to deal with the negative consequences of potential unfavorable outcomes, something that a mature, older investor may not have. Now we come to our fourth fundamental, and it is an exceedingly important one. It is the importance of having a diversified investment portfolio. This means that we must try to invest in different types of investments to avoid the all eggs in one basket strategy that has ruined many people when their undiversified investments go bad at once. In time, we will discuss the risks associated with asset classes, which can vary from almost no risk to very risky. If you choose to invest in all very risky sorts of investments, you face a disaster scenario when risky investments perform poorly at the same time. The first rule of diversification is just in terms of sheer number of investments. You must resist the temptation to go all in, the popular term in the poker world, because you won't be very happy if your choice turns out badly. So it is best to be diversified across your choice of asset classes. One of the big mistakes occurred during the tremendous bull run in stocks from 1997 through the early days of 2000, and that was because of the spectacular returns of the stock market during that period of time. This encouraged investors to put more and more into the stock market, even to go as far as to borrow money to invest in the stock market and leveraging themselves to gain more stock market exposure. Emboldened by success, many were determined to have every cent in the stock market and then some, as this very market was richening at an unsustainable pace. Indeed, a stock market bubble of historic proportions was forming because of this frenzy caused by those years of spectacular gains. So when the inevitable occurred, it became apparent that the stock market was overpriced, and as a consequence, one of the worst downturns in stock market history occurred, damaging and in some cases ruining people's savings, which they spent a lifetime building. If that wasn't bad enough, then 5 years later, another bubble of historic proportions in the real estate market, spurred by flawed politics and policies, caused everyone to want to own a home, and were encouraged to do so even though the financial circumstances and terms were not necessarily favorable for some of those buyers. Worse than that, some chose to own two or more homes. Once again, the buying frenzy of homes, fueled by enhanced demand, when buyers benefited from that frenzy, created a bubble where too many homes were purchased by people who really had no business owning a home at that point in their lives. Worst, flawed real estate investment products were created by this insatiable demand, and many of these new products had bad risk profiles and were far riskier than people thought. Finally, the frenzy caused homes to become severely overpriced at a time when demand was greatest and more houses were being purchased, and became many people's main and only investment. So the first rule of diversification is to spread your investments across asset classes to protect yourself from the failure of one asset class's weakness. In a similar fashion, in choosing an asset class, one should consider being diversified in that class itself. For example, if you decide to own stocks, then owning one favorite stock or even just a couple is a bad strategy, even though at times that might perform favorably. Owning a diversified selection of, say, 10 or more stocks is a better risk tactic. One should consider investing in different industries and companies domiciled in different locations. One might consider investing in a stock mutual fund, which offers a diversified selection of many, even hundreds of stocks. If one wants to buy a second home as an investment, one should consider buying a second home in a different location from the first owned home. So being diversified in an asset class is very important in making your investment decisions. We will continue our discussion on risk at a later time. Thank you.